Hi, welcome to this video on the internal rates of return. We're going to explore what it is and how to calculate it in Excel. Let's get started with what is the internal rate of return. Internal rate of return, often abbreviated as IRR, is a method used to evaluate long-term capital projects or investments. So it assists management in the decision-making process when they need to choose between different projects or different investments. The internal rate of return formula accounts for the time value of money by present valuing all known future cash flows by some rate of return so that it equals the initial investment. When those conditions are met, when the present value of the known cash flows is equal to the initial investment, then the rate that we have used to do the discounting is equal to the internal rate of return. And in this video, we're not going to look at the mathematical, iterative numerical analysis techniques that's behind this calculation. If you do want to look at that, there's a free lesson on our website that covers the Newton Raphson method and an application in finance. There'll be a link in the description below. For the purposes of most corporate finance courses, however, you just need to understand the internal rate of return method, what it means, how do we calculate it, and that we'll illustrate in Excel. So another method, another way of thinking of the internal rate of return is if we revisit the concept of the net present value. And if you haven't watched the video on NPV or the net present value, please click here, or after this video, follow the link in the description to that NPV video. So the NPV is found by, again, present valuing all known future cash flows using this weighted average cost of capital and subtracting that right there, weighted average cost of capital, and then subtracting the initial investment. We make it time zero. So no discounting required because it's already at time zero. If we take this same concept, but now we say we're discounting at some rate, and this rate, when the present values that are calculated is equal to the initial investment and we subtract them from one another, then the NPV is zero. Then in actual fact, this rate that we have calculated is the internal rate of return. Let's break it down with an example. The ACM factory produces building materials to the construction industry. The business is currently in the market to invest in a new machine that will mold sustainable and environmentally friendly cement blocks. The internal research and development team at ACM, in conjunction with the management team, are faced with a decision that requires them to choose between two different machines, which we'll label Project A and Project B. Either machine will involve an initial investment of $3,000, and each machine is expected to generate a series of cash flows for a period of 3 years. At the end of the 3 years, the machine will be obsolete with no resale value. Due to its limited capital budget, ACM must select the machine or project which will result in the highest profitability. This is where the IRR calculation comes in. Project A is expected to produce the following cash flows, and Project B is expected to produce these cash flows. Keep in mind that outflows of cash, in this case the initial investment, will be depicted as a negative value, and the cash inflows are depicted as positive values. In order to calculate the present value of each individual cash flow, as mentioned earlier, we have to solve for the discount interest rate that will equate the present values of the inflows to the initial investment. It is now time to do this calculation in Excel. So we have cash flows in each of these periods this is at the end of each year, 0 initial investment of 3,000, negative outflow. And then at the end of year 1, 2, and 3, these are the different inflows for project A. So we need to use a guess for what is this initial interest rate that we're going to be using. So we'll start this off with 10%, just so we have some value. And then what we're going to do is take the cash flow itself, and we don't need to actually have brackets around it, but we'll just put brackets there just for completeness sake. C8, so that is 1 plus 10%, and we use F4 there to dollarize that value because we want that as a fixed reference to sell, to the power T. So for each year, this is how we do the discounting there. So the first cash flow after 1 year at a discount rate of 10% will be 2,955. The 250 will be 207. The 150 will be 113. And when we add those up, the present value of these inflows is 3,273. That's not equal to the outflow that we have. So what we then do is we're going to adjust this. Instead of 10%, let's try 12%. It's now 3,200. It's still not. It's not close. It needs to be 3,000 outflow, 3,000 inflow. When that happens, the interest rate that solves that equation, we A4 away. So let's try 14%. Still not there. Let's try 16%. We're very close now. We're at 3,083. Let's try 18%. 3,025. Okay. So now we're very, very super close. So 20%, 2,968 we've gone past. So let's try between 18 and 20. We got 19%. Still too much discounting. 18.5. A little bit less. We need to do a little bit more discounting because it's over 3,000 again. 18.6. You see how we do this manually now as an iterative process. So there's a faster way of doing this. If we use the internal rate of return formula provided by Excel, use it in capitals, we're going to equal that cell to IRR. Select the cash flows. Now this comes with a couple of caveats as well. There needs to be a negative value. There needs to be equally spaced values as well, equally spaced cash flows. So the formula we had now, there's another way of doing it. We'll do that with project B. So I'll show you that method. Another thing that's interesting is it asks us to say, well, what are those values you want to discount, and then give us a guess. If you don't provide a value here, it starts with 10%, and we'll leave it then at 10% because that's where we started our manual iteration process as well. So pressing enter, we get the IRR formula tells us at 18.88%, let's see if there are more decimals, 8810, then that will be, so 18.88, you can see 18.881 will be exactly 3,000. Okay, so that's the first method of doing this as an iterative process, a manual iterative process. So we've illustrated the logic behind what this calculation is. Now, what we're going to do next now, these are the cash flows associated with project B. I'm going to show you a different method to calculate this. So again, the cash flow divided by 1 plus this interest rate, but we're going to dollarize it, meaning between C and 8, we press F4 to make both of those fixed cell references, and to the power 1. So that's the actual discounting that happens here. Now what we're going to do, instead of manually sitting and guessing, we can use a function called goal seek. We've now discounted these cash flows. We're saying discount them at 10% and add them up to be this particular present value. Then we can also say plus add to this value the sum, the initial investment. And we're saying, well, the difference is 325. When is this going to be the internal rate of return? When that NPV is 0. So in other words, we know 10% isn't the correct value. Okay, so what we're going to do next is we have these different cash flows. I see that I have this as WACC there. Let me just change that to R as well. So in other words, 1 plus R, whatever this interest rate is, to the power T. then we're going to calculate this value here. So this has been set to the sum of those inflows plus the initial outflow. Because it's a negative value, when you add the negative value to that, it's actually subtracting it. So it's giving us a difference there. So this is, in actual fact, what we calculated here is exactly the NPV calculation, assuming 10% was the weighted average cost of capital. But we're not doing an NPV calc here. So what we're going to do is we now go to data and what if analysis, then goal seek, and we say set cell C7, in other words, the present value of inflows. In fact, let's just change the labeling here. So the present value, let's just say the NPV value, the net present value of all the cash flows, cell C7 equal to 0 by changing, here's the magic part, the interest rate value, the 10%. And now this will follow a numerical method behind the scenes called bisection to find this value. And this time it arrived at 14%. So saying at 14% exactly, let's see if we add some more decimals to this. Oh, not exactly, 140119, and there's plenty of decimals. Then the net present value will be 0. So just to do a little sanity check, let's employ Excel's internal rate of return formula again. We're not going to insert a guess. We're starting with 10%. We're happy with that. And, oops. Did I do this correctly now? I did not do this correctly because the cash flows need to be these ones here. Okay. 40192. This is the same amount of values. Okay. So there we've got an alternative way of calculating it. Both of those, we use the internal rate of return formula provided by Excel, but then also in the first instance, we actually looked at how do we do this if we had to do this manually, ourselves doing some guesses and things. And secondly, we're saying, well, there's also a goal seek formula which is built on a numerical analysis mathematical technique that we can use in this instance as well. And in some instances, when that might be a preferable method of actually solving for the internal rate of return. So we've done our comparison and we can see that project A produces an internal rate of return of 18.9% when we round this to a single decimal value, and project B produces 14.0%. So if we had to choose between these two, or the management of the company having to choose the capital constraint in play, they would have to opt for project A, provided that it exceeds the weighted average cost or WACC of their capital. Okay, so this method, this internal rate of return method, is closely associated with the net present value capital budgeting method as well. And as mentioned before, if you haven't watched the video on NPV, here's a link to that video now. And alternatively, if you want to know more about the mathematics, in the description, there's a link to our website for a free lesson on a method called the Newton Raphson method. If you want to know a little bit deeper into the mathematics that go into this type of iterative process. And lastly, sometimes we get conflicting rankings between internal rate of return project rankings to NPV rankings. And if you want to know why we get those and what conclusions we can draw from those conflicting rankings, there's another video that you can watch on that. And for that video, please click here. Thank you for your attention.